Usually, when you walk onto a casino floor, the mathematical reality of your situation is completely invisible, but it is absolute.
Oh, yeah. The house edge is meticulously engineered into every single game they have.
Exactly. I mean, you look at the roulette wheel, right? It has those two green spaces. The blackjack dealer is forced to hit on soft 17.
Right. Over a long enough timeline, the architecture of probability just guarantees that the house extracts capital from the players.
Yeah, as a participant, you're basically trading your capital for a temporary thrill, and you are fully subjected to the laws of probability.
It's a perfect asymmetrical relationship. I mean, you take the volatile risk, and the house just manages the long-term probabilities.
They really don't care if you win a single hand.
Not at all, because they are playing the law of large numbers.
But when you step out of the casino and look at the world of global property and casualty insurance, you're essentially looking at an industry that operates as the casino for the entire global economy.
That is a fascinating way to frame it, because they are managing risk, just on a completely different scale.
Exactly. Except instead of managing the risk of a spinning wheel or, a deck of cards, they're managing the risk of cargo ships crossing the Pacific.
Or massive data centers in Virginia.
Right. Agricultural crops in the Midwest, the cyber infrastructure of Fortune 500 companies. The risks are infinitely more complex, but the underlying mathematical goal is exactly the same.
Which is to build a system of probability where the house always wins.
Always wins. That is the defining mechanism of the industry.
It really is. It's institutionalized probability management at a global scale. And the reality is, when an insurance operation perfects that mathematical architecture, it becomes one of the most magnificent, resilient wealth creation engines ever devised in the financial markets.
Which brings us to the actual subject of our deep dive today. We're looking at the Q4 2025 earnings call of Chubb Limited.
Trading under the ticker symbol CB.
Right. And look, the goal here is to strip away the dense Wall Street jargon and really look under the hood of this operation.
Because the narrative setting up this specific quarter isn't just that Chubb had, a decent 3 months.
No, the data suggests they're operating as a record-breaking machine at absolute peak efficiency. And we're going to give you a clear, opinionated take on whether these results are a bullish or bearish signal.
And just to frame the sheer scale of the house we're talking about here, Chubb isn't the company you call just to get a liability policy for your teenager's used car.
Yeah, they are a global titan. I mean, they operate in 53 countries.
53. They underwrite everything from micro-accident and health policies for consumers in Asia to massive multi-billion-dollar commercial property lines in the U.S.
Down to specialized agricultural crop coverage. They are just deeply embedded in the foundational bedrock of global commerce.
So true.
So let's get straight into the architecture of this quarter, starting with the headline numbers. And I want to pause on these because the velocity of the growth here is actually jarring for a mature financial institution.
Jarring is a good word for it. Let's hear the numbers.
For the fourth quarter of 2025, core operating income came in at nearly $3 billion. That is a 22% increase.
Wow.
Yeah. Earnings per share for the quarter hit $7.52, up 25%.
And zooming out to the full year.
Their operating income just missed the $10 billion mark, landing at $24.79 per share.
To really put that into perspective, CEO Evan Greenberg provided a look back during the call that contextualizes the momentum.
What did he highlight?
Well, over the past 3 years, their core operating income has grown 55%. But over the past 5 years, it has grown over 200%.
Wait, 200% growth in 5 years?
Yeah, 200%.
That sounds like the trajectory of a Silicon Valley software company, not a century-old property and casualty insurer. I mean, how does a defensive, risk-bearing financial institution compound capital at that rate?
It comes down to mastering two parallel engines: underwriting discipline and capital leverage.
Okay, break that down for us.
To really understand how they are printing this much cash, we have to look at the holy grail metric of the insurance industry. It's called the combined ratio.
Right, let's unpack the combined ratio because this is where the jargon usually loses people.
It can get decks, yeah.
The way I like to think about it is like a factory's operating cost. If it costs a factory owner 81 cents in raw materials and electricity to manufacture a product that they sell for $1, their operating ratio is 81%.
So they pocket 19 cents of pure profit.
Exactly. In the insurance world, the product is the policy. If the company pays out 81 cents in claims and administrative expenses for every dollar of premium they collect, their combined ratio is 81%.
Anything under 100% means the company is turning a pure profit on the actual underwriting.
Right. That analogy hits the mechanics perfectly, I think.
It does. The combined ratio is simply the loss ratio, the money paid out for claims, plus the expense ratio.
Which is the cost of running the business, paying brokers, keeping the lights on.
Exactly. So looking at Chubb's Q4 property and casualty, or P&C, combined ratio, it came in at 81.2%.
Leaving them with an 18.8% profit margin on the risk itself.
Which is fantastic. But the transcript gets even more granular. They reported a current accident year combined ratio of 80.4%.
Let me stop you there, because the distinction between the standard combined ratio and the current accident year ratio seems pretty crucial.
It is entirely crucial.
Are they just stripping out bad data to make the number look better?
No, it's not about stripping out bad data. It's about isolating current performance. The published combined ratio of 81.2% includes everything that impacted the balance sheet in that specific quarter. That includes adjustments they have to make for claims that happened 3, 4, or even 5 years ago.
Like, say, an old lawsuit.
Exactly. If a lawsuit from a 2021 liability policy settles for more or less than they originally estimated, that financial adjustment hits today's combined ratio. That is called prior period development.
So it basically creates noise. It blends the underwriting decisions made half a decade ago with the decisions being made today.
Precisely. The current accident year combined ratio strips all of that historical noise out.
Oh, I see.
It isolates only the performance of the policies written and the claims that occurred in this specific current year. It is the purest, most unvarnished look at how disciplined their underwriting teams are acting right now.
And an 80.4% current accident year combined ratio is, frankly, that's an absurdly strong number in this industry, isn't it?
It is staggering.
That implies they are keeping nearly 20 cents of pure profit on every dollar of premium taken in today. That requires an underwriting culture made of titanium.
Absolutely.
Because, from what I understand, a lot of insurance companies are perfectly happy to run at a 98 or 99% combined ratio. They essentially just break even on the risk.
Many do, yes. And the reason they tolerate breaking even on the underwriting is because of the second engine I mentioned.
Capital leverage.
Right. Specifically through what the industry calls float. When you pay your insurance premium in January, the insurance company might not have to pay out a claim on that policy until November, or perhaps never.
And in the meantime, they are holding your cash.
And they don't just put that cash under a mattress.
They invest it heavily.
That pool of collected but unpaid premiums is the float. It acts as a massive zero-cost, or in Chubb's case, negative-cost loan.
Because Chubb is generating a 19.6% profit on the underwriting, and they still get to invest the billions of dollars in premium while they hold it.
It's an incredible setup, which perfectly transitions to the other side of these headline numbers, their investment income.
Oh, right. Let's look at those numbers.
They reported record-adjusted net investment income of $1.8 billion for the single quarter.
For one quarter.
One quarter, that's up 7.3%. And they're yielding 5.1% on their fixed income portfolio.
Let's contextualize that $1.8 billion. The transcript says they ended 2025 with total cash and invested assets exceeding $171 billion.
The sheer scale of their balance sheet is just monumental.
Yeah, they're taking in more premium. Total company net premiums grew almost 9%. They're underwriting it with extreme 80.4% efficiency. And they're taking that massive expanding pool of float and dropping it into a fixed income market yielding over 5%.
It is literally a self-feeding financial loop.
Yeah. But this is where the transcript gets genuinely fascinating to me.
How so?
Because when you look at these record profits and this flawless combined ratio, you would just naturally assume 2025 was a quiet, sunny year with very few disasters.
Right. You'd think the weather was perfect.
But the data reveals what I'm calling the catastrophe paradox.
Because the underlying reality of the risk environment in 2025 was incredibly volatile.
Extremely volatile. The transcript shows that catastrophe losses, what the industry calls cat losses, were actually significantly higher for the full year of 2025 than they were the year before.
By a wide margin.
Yeah. Chubb took $2.9 billion in pre-tax catastrophe losses compared to $2.4 billion in 2024. This was largely driven by the severe California wildfires in the first quarter, compounded by a global mix of weather events.
And Evan Greenberg provided the macro context for this. He noted that even though the traditional U.S. and worldwide hurricane and typhoon seasons were unusually light-like, we didn't see a massive Category 5 storm wipe out Miami. Annual industry-wide catastrophe losses still approached $129 billion.
That's a massive hit for the industry.
It is. He explicitly stated that the frequency and severity of losses from secondary perils, fires, floods, cyclonic events, localized earthquakes are alive and well.
Okay, so the industry at large takes a $129 billion hit. Chubb's own internal catastrophe losses jump by $500 million year over year.
Right.
How on earth does a company absorb a $2.9 billion crater in their balance sheet and simultaneously post the highest record profits and the best combined ratio in the history of the firm?
It seems impossible.
If you take a massive hit at the blackjack table, the casino's nightly profit should drop.
Not if the casino has 10,000 other tables operating perfectly across the globe.
Okay.
This paradox proves the absolute structural integrity of Chubb's pricing models and their geographic diversification.
So they're just spread out enough to absorb it.
Exactly. Because their exposure is spread across so many distinct product lines and international borders, a $2.9 billion localized shock like the California wildfires does not capsize the ship.
The losses are entirely absorbed by the sheer volume of highly profitable premium flowing in from the thousands of other tables that didn't experience a disaster.
You've got it. It's winning a marathon with a rock in your shoe.
So they aren't just crossing their fingers hoping a wildfire doesn't happen.
No, they're mathematically assuming it will happen, and they've already priced the global portfolio to cover it.
That is the essence of pricing for volatility. Greenberg pointed out during the call that catastrophe exposure is inherently volatile. You cannot price an insurance policy based on what happened last month.
You really can't. You might have a 2-year period with outsized catastrophes where you bleed capital in a specific region, followed by a 3-year quiet period where you print money.
So the actuarial science demands that you measure the risk over an extended 10-year curve.
Yes. You have to ensure that the baseline pricing is technically sound enough to cover the long-term trend line of climate volatility.
And the fact that their combined ratio dropped while their cat losses rose proves their baseline pricing is structurally bulletproof.
It really does. The rock in their shoe doesn't slow them down because their overall momentum is just too massive.
Which brings us to the actual engines driving that momentum. Because if catastrophes were the headwind, the transcript reveals 2 distinct rocket boosters that powered this quarter's unprecedented growth.
Let's look at the first one, the massive boom in U.S. agriculture.
The agriculture numbers were truly a standout anomaly. I mean, their North American agriculture business grew premiums by over 45% in a single quarter.
45% top-line growth is just staggering.
But why? Did farmers suddenly buy twice as much insurance? Or did food prices just skyrocket?
It is deeply tied to the mechanics of how crop insurance works in the United States. And honestly, for you as an investor, understanding this mechanism is vital.
Walk us through it.
Crop insurance in America is not a purely private enterprise. It is a highly integrated public-private partnership managed through the Federal Crop Insurance Corporation.
Right, because if a massive drought wipes out the entire Midwest, a purely private insurance company would go bankrupt trying to pay all those claims at once.
Exactly. The systemic risk to the food supply is just too big.
So the federal government steps in.
They step in, they subsidize the premiums for the farmers to ensure everyone participates, and they share the ultimate risk and the profit with private insurers like Chubb, who provide the operational infrastructure.
Chubb actually administers the policies, adjusts the claims, and utilizes their technology to manage the network.
And Chubb happens to be the #1 crop insurer in America.
Okay, so how does the profit sharing actually trigger a 45% growth spike in a single quarter?
It operates under what is called the Standard Reinsurance Agreement. Essentially, if the agricultural sector has a strong year, meaning crop yields are solid and commodity prices remain stable, the overall losses are very low.
Which is good for everyone.
Right. And the government formula dictates that when the risk pool performs exceptionally well, a significant portion of that underwriting profit is shared back to the private administrators based on the volume of risk they retained.
So when those favorable conditions hit in Q4, it dropped massive, highly profitable volume straight onto Chubb's income statement.
Exactly. They are effectively monetizing the administrative efficiency of the American agricultural heartland.
And Greenberg mentioned this wasn't just top-line vanity revenue. He said the underlying current accident year combined ratio benefited immensely from agriculture's outstanding results, pulling the entire company's average down to that record 80.4%.
He did say that, but he also provided a very crucial caveat to prove the health of the broader company.
What was the caveat?
He made a point to state that even if you entirely exclude the agriculture business from the math, the global P&C current accident year combined ratio was still 80.4%.
Wait, really?
Yeah.
So the core commercial and consumer business is operating at the exact same extreme level of efficiency as a booming government-backed crop portfolio.
Precisely. The agriculture boom was a massive windfall, but it merely matched the underlying operational excellence of the rest of the company.
Wow. Which transitions us perfectly to the second engine of growth, because it is located as far away from an Iowa cornfield as you can get.
It really is. It's their international consumer explosion.
And this is where the transcript reveals a strategy that feels completely modern.
It's an area where Chubb is quietly dominating, and the broader market doesn't seem to fully price in the moat they are building.
Let's hear the numbers on that.
The numbers are striking. Overseas general premiums overall were up 10.8%. But when you dissect the regions, Latin America grew 14.7%, with their consumer segment up almost 18%.
Okay, and Asia?
In Asia, overall growth was 13%, but the consumer lines were up a staggering 25%.
Let's define consumer lines here, because when I think of consumer insurance, I think of, Geico or Progressive Commercials selling auto insurance.
Right.
Is Chubb just running localized TV ads in Tokyo and Sao Paulo to get 25% growth?
Not at all. The underlying product is primarily accident and health, or A&H, along with specialized personal lines.
So these are supplemental policies.
Exactly. Things like hospital cash benefits, travel insurance, or specific accident payouts.
Got it.
But the true innovation is the distribution mechanism. They are not building brick-and-mortar storefronts or relying solely on traditional armies of local brokers.
So how are they getting to the consumer?
They are embedding their underwriting engine directly into the digital infrastructure of these markets through massive exclusive partnerships.
So they're integrating into platforms that already have millions of daily active users.
Exactly.
Give me the specific examples from the call, because this is where the abstract strategy becomes very real.
Greenberg explicitly named the pillars of this strategy. In Chile, they have a massive partnership with Banco de Chile, the largest bank in the country. In Ecuador, it's Banco de Guayaquil.
Okay.
In Mexico, they serve as the exclusive long-term insurance partner for Banamex. But the crown jewel he highlighted, the one driving immense volume in Brazil, is their partnership with Nubank.
Nubank. That is massive.
It's huge.
For you listening, if you aren't following international fintech, Nubank is one of the largest, most disruptive digital banking platforms on the planet. They have tens of millions of highly engaged customers who manage their entire financial lives through a single app.
Exactly. So imagine the user flow. A consumer in Brazil logs into their Nubank app to check their checking account balance or pay a utility bill.
Right.
Right there in the interface, seamlessly integrated, they are offered a micro accident or health policy. The user clicks a button, the premium is automatically deducted from their Nubank balance monthly, and they are insured.
And the friction is basically zero. But more importantly for Chubb, the customer acquisition cost must just drop through the floor.
Oh, completely.
If you use a traditional broker, you are paying a 15 or 20% commission on every policy. If you use an API integrated into Nubank, your distribution cost is a fraction of that.
That is the entire genius of the model. By utilizing digital direct marketing, and Greenberg noted they consider themselves the #1 direct marketer of insurance in Asia, they fundamentally alter the expense ratio of the policies.
Because these A&H policies are high-frequency, low-severity risks, it's a pure volume game.
Right. By drastically lowering the cost to acquire and service the customer through digital banking partnerships, they generate a highly predictable, incredibly steady underwriting margin.
But surely they aren't the only ones who have figured this out. I mean, an analyst from Morgan Stanley pushed back on this exact point during the Q&A, didn't he?
He did. He pointed out that every global insurer is drooling over the Asian and Latin American consumer markets. Capital is flooding in.
Right. How is Chubb actually defending this turf against new entrants who can also build an API?
Greenberg's response to that was a masterclass in understanding geopolitical and regulatory friction. He gave a very sobering, realistic view of the landscape.
What do you say?
He pointed out that Asia is not a single market you can just plug into. It is a massive, fragmented region made up of highly distinct micro-markets and large traditional economies, each with entirely different languages, cultures, banking regulations, and compliance hurdles.
Right, you can't just write one piece of code and deploy it in Indonesia, Japan, and Vietnam simultaneously.
Precisely. You cannot just parachute in, rent an office in Singapore, hire 3 underwriters, and claim you are a pan-Asian insurance player.
It doesn't work that way.
Greenberg said it requires years of hard yards to build localized franchises. You have to navigate the local regulatory bodies, secure the specific banking licenses, and build trust with the legacy financial institutions in each individual country.
So it's basically a regulatory moat.
A massive regulatory relationship moat. And once you have that localized footprint, you then have to deploy your global technology, data analytics, and balance sheet to give those local teams a competitive edge.
Because a tech startup might have a great app, but they don't have a $170 billion balance sheet to back the risk.
Exactly. And a local insurer has a balance sheet, but not the global AI and data infrastructure.
Chubb has spent a decade doing the hard yards to combine both. A new entrant simply cannot replicate that infrastructure overnight, no matter how much capital they raise.
It's a huge competitive advantage.
That paints an incredibly bullish picture. You have record underwriting profits. You are insulated from massive catastrophes. Your agricultural public-private engine is booming, and your international digital moat is widening.
It's an impressive list.
But as an investor, the rearview mirror only tells half the story. We have to look at management guidance for 2026. What are they actually projecting?
This is where we run into Evan Greenberg's famous philosophical aversion to Wall Street's quarterly expectations game.
He was incredibly blunt about it, wasn't he?
Very blunt. When an analyst from UBS asked a very standard question, essentially, can you sustain these incredible margins into 2026, given where pricing is heading? Greenberg just shut it down.
He said, I don't give forward guidance, as you know.
Yeah, he is a staunch traditionalist in that regard.
Yeah.
He manages Chubb for long-term intrinsic value creation, not to ensure analysts can perfectly balance their quarterly spreadsheet models. Later in the call, when discussing the financial payback of their long-term digital investments, he explicitly said that this transformation wasn't something that was going to fit neatly into worksheets where he gives incremental quarterly updates.
He believes that hyper-focusing on 90-day increments misses the entire point of building a generational financial institution.
Exactly.
Look, I respect the philosophy, but we still need to forecast the business. Even if the CEO won't give a neat EPS projection, there has to be data in the transcript we can extrapolate from. What did the CFO, Peter Enns, actually reveal?
While Greenberg handled the philosophy, Enns did provide very concrete near-term financial parameters.
Okay, hit us with those.
For the first quarter of 2026, he explicitly guided that adjusted net investment income will be between $1.81 billion and $1.84 billion.
So, despite potential interest rate volatility, they expect the investment income engine to accelerate even further from the $1.8 billion record they just hit in Q4.
Yes, the float continues to compound. He also guided that the annual core operating effective tax rate for 2026 would land in the range of 19.5% to 20%.
Okay, good to know.
But honestly, the most crucial piece of forward-looking sentiment came from Greenberg himself, right at the end of his prepared remarks.
Oh, despite his hatred of formal guidance.
Yes, the underlying momentum basically forced his hand. He stated they are off to a very good start in 2026, and then he explicitly targeted double-digit growth in EPS and tangible book value.
Double-digit growth in earnings per share.
Yes.
For a $70 billion insurance company to confidently project double-digit EPS growth requires massive conviction in their pricing power.
It does. Now, he added the standard underwriter caveat, cats and FX aside.
Meaning, assuming we don't have a globally unprecedented string of natural disasters or a complete meltdown in foreign exchange rates.
Right. But underlying that caveat is supreme confidence in the fundamental day-to-day earnings power of the machine.
And one of the primary mechanisms they're relying on to achieve that double-digit growth brings us to perhaps the most modern, transformative aspect of the entire call.
The digital transformation.
Exactly. They are targeting a massive efficiency gain through Gen AI and digital infrastructure.
This is where Chubb starts to look less like a traditional underwriter and more like a forward-looking technology platform.
How so?
They have publicly staked their reputation on achieving a 150 basis point improvement in their combined ratio over the next 3 to 4 years, driven entirely by digital transformation.
Let's do the math on that to understand the sheer scale of what 150 basis points means.
It's a lot.
A basis point is 1/100%. So 150 basis points is a 1.5% improvement. If their combined ratio is 81.2%, they want to push it down below 80%.
Which is almost unheard of.
If a company is writing over $50 billion in net premiums annually, shaving 1.5% off their costs translates to roughly $750 million in pure bottom-line profit generated purely from internal efficiency.
It is a monumental figure. It is the equivalent of acquiring a highly profitable mid-sized insurance company, except they are just extracting that value from their existing operations.
But how?
Yeah.
An analyst from Citi pushed him on this exact point, demanding to know the key drivers and execution priorities. Like, how does Gen AI actually shave $750 million off an insurance company's operating costs? Are they just firing thousands of human adjusters?
No, and Greenberg was very specific about the mechanics of this. He explained that the vast majority of this improvement will manifest on the expense side of the ratio, specifically in operating expenses and the actual cost of managing claims, known as loss adjustment expenses.
Give me a tangible example of how AI reduces a loss adjustment expense.
Think about the life cycle of a standard property claim. A tree falls on a roof. Historically, a human claims adjuster has to drive to the house, physically inspect the damage, write up a report, cross-reference the policy limits, and submit it for manual approval.
Which takes days. And it costs the company hundreds of dollars in labor and logistics just to process the claim.
The friction is incredibly high.
Right.
Now, introduce a digital infrastructure model. The homeowner takes photos of the roof with their smartphone and uploads them to the Chubb app.
Okay.
A specialized AI vision model instantly analyzes the imagery, confirms the extent of the damage, cross-references local material and labor costs, verifies the policy limits in milliseconds, and automatically triggers the payout via straight-through processing.
Wow.
The claim is settled in 3 minutes, and the cost to process it drops from hundreds of dollars to a few cents of computing power.
Multiply that by millions of claims globally, and you can clearly see how they extract $750 million in expense savings.
Exactly. Greenberg noted they have identified 9 or 10 very discrete, highly focused operational projects across all their major geographies: North America, Europe, Asia, Latin America.
So they aren't just giving the company a ChatGPT subscription.
No, they have dedicated, specialized technical teams focusing on data, analytics, and AI, embedded directly alongside the business leaders to fundamentally re-engineer how the company operates.
He also mentioned that there is a minority projection of improvement in the actual loss ratio, meaning they believe AI might actually help them select better risks and avoid bad policies entirely.
Right. But he noted they are fact-based people, so they are relying heavily on the mathematical expense savings they can track today, rather than theoretical underwriting improvements.
It is a highly disciplined, pragmatic approach to technological adoption. And this raised a fascinating cultural question during the Q&A.
Yes, it did. An analyst from Wolf Research brought this up.
She noted that the insurance industry is notoriously traditional. She called it a tribal culture, built on relationships and human intuition.
She asked how the veteran underwriters and legacy claims folks are handling this aggressive digital reinvention.
I thought his answer to this was the leadership highlight of the call. He didn't offer corporate platitudes.
Not at all.
He defined culture practically as norms of behavior that all hold in common. He described Chubb's specific internal culture as a strict meritocracy, highly disciplined, and completely focused on individual accountability.
He essentially stated that the culture is built to adapt to reality.
Right.
He expressed immense confidence that his colleagues globally understand that the digital transformation of society is a permanent reality. They know that to remain relevant in the future economy, they have to learn these new skills, adapt to the technology, and evolve their workflows.
He basically said, look, the train is leaving the station, we are driving it, and you need to be on board and do the hard work.
It was profound.
But as analysts, we have to balance this internal optimism with external reality, because management also raised a significant warning flag about the macroeconomic environment they are operating in.
Yes. The commercial insurance market is softening.
And this is the critical counterweight that any investor needs to monitor. We've talked about record profits, but the actual environment for pricing large corporate risks is deteriorating.
The commercial P&C underwriting environment is definitively in transition. Globally, it is growing incrementally more competitive quarter by quarter.
Let's explain that. When the market is softening, it means that insurance capital is abundant.
Right. Other insurance companies are desperate for market share, so they start dropping their prices to win business away from competitors.
Which puts immense pressure on Chubb. If a competitor offers to insure a Fortune 500 company's supply chain for 15% less, Chubb has to decide whether to match the lower price and sacrifice their profit margin or walk away and lose the revenue.
Exactly. And the most striking data point illustrating this was in property pricing. Greenberg revealed that pricing was down over 13.5% in their large account business and in E&S.
Okay, let's unpack E&S, because that is a massive part of the commercial insurance ecosystem. It stands for excess and surplus lines.
It does.
What exactly is that, and why is a 13.5% price drop there so significant?
Well, the insurance market is generally split into two halves. The admitted market is standard insurance, highly regulated by the state, using standardized forms and rigid pricing models.
Okay.
But some risks are too complex, too large, or too volatile for standard models. Think of a massive lithium-ion battery recycling facility or a new offshore wind farm.
Standard insurers won't touch it.
Exactly. That risk flows into the excess and surplus, or E&S, market.
So E&S is basically the laboratory for weird, dangerous, and complex risks.
Precisely. And because the risks are complex, E&S carriers have freedom of rate and form. They can charge whatever premium they deem mathematically necessary, and they can customize the policy language extensively. Because of this flexibility, it is traditionally a highly lucrative space for insurers with the intellectual capital to understand the risk.
And Chubb is a massive player in E&S.
They are.
But if they have freedom of rate, why is pricing dropping 13.5%? And more confusingly, how can property pricing be down 13.5% when Evan Greenberg just told us in the same breath that catastrophe losses are alive and well, and the industry just swallowed $129 billion in damage?
It seems contradictory.
If the risk is high, shouldn't the price be high?
It highlights the sometimes irrational nature of the insurance capital cycle. Over the past few years, property pricing was very high, creating massive profits. Those profits attracted new capital into the industry. Hedge funds, catastrophe bonds, alternative capital vehicles. Suddenly, there is an oversupply of capital looking to back property risk.
So to deploy that capital, competitors start undercutting each other.
Exactly. They drive the price down 13.5%, completely ignoring the fact that the underlying climate risk and frequency of catastrophes have not decreased at all.
So the market is essentially mispricing the risk because they are blinded by the competition for volume.
Exactly. And navigating this requires immense discipline. Greenberg made it very clear that Chubb is willing to shrink their exposure in these lines rather than write bad business just to maintain market share.
If the price doesn't meet their strict actuarial targets, they walk away.
Yes.
But the softening isn't universal. Greenberg noted a sharp divergence in the market. While property pricing is down, casualty pricing, which covers liability, lawsuits, and negligence, is actually up 8.5% in North America.
It's a huge contrast.
Why is casualty firming up while property collapses?
That brings us to one of the most toxic dynamics currently plaguing the American economy: social inflation.
Social inflation. This is a term that gets thrown around Wall Street, but it fundamentally impacts every single consumer and business.
It does.
Greenberg addressed this head on when an analyst brought up the political pressure surrounding the affordability of insurance. He pointed out that liability costs in the United States are rising dramatically.
He estimated that inflation for liability claims is running at roughly 7 to 9% annually.
He explicitly said that's multiples of CPI. The broader consumer price index might be cooling down, the cost of a gallon of milk might be stabilizing, but the cost of getting sued in America is skyrocketing.
It is escalating at an unprecedented rate. Greenberg bluntly called it a problem with litigation, not a problem with the insurance industry.
And regardless of where you stand politically, the mechanics of this are just fascinating as a market dynamic.
They are. It's driven by several factors. First, you have third-party litigation funding, or TPLF. Hedge funds and private equity firms are literally investing in lawsuits.
Really?
Yes, they front the money for massive plaintiff firms to drag out litigation against corporations, taking a large percentage of the final settlement as their return on investment.
So lawsuits are no longer just about making an injured party whole. They are functioning as high-yield alternative asset classes for Wall Street.
Precisely. Add to that the changing psychology of juries, who are increasingly handing down what the industry calls nuclear verdicts, judgments in the tens or hundreds of millions of dollars designed to punish corporations rather than simply compensate for damages.
Which means the historical actuarial data that an insurance company uses to predict liability costs is completely broken.
Entirely broken.
If a slip and fall claim that cost $50,000 to settle a decade ago now results in a $5 million jury verdict, the insurance company's reserves are instantly wiped out.
Exactly. So how does Chubb respond? They have to raise their casualty prices by 8.5% year over year just to keep pace with these escalating engineered loss trends.
And this inevitably leads to politicians screaming at the insurance companies, accusing them of price gouging and demanding they lower rates for consumers and small businesses.
Which happens constantly.
Greenberg had a very sharp, uncompromising warning for regulators about this, didn't he?
He did, and it is a fundamental lesson in economics. He stated, "We intermediate money, we don't print money."
Meaning they only collect premiums to pay the claims. If the claims cost more, the premiums must mathematically rise.
Exactly. He warned that if politicians attempt to politicize the affordability question, if regulators artificially suppress insurance rates below what the actuarial science demands, it will trigger an availability crisis.
Because if an insurer is legally forced to sell a liability policy for $1,000 when they know the mathematically expected loss is $2,000, they will just stop selling the policy.
They will pull out of the state entirely. Capital goes where it is treated fairly.
And Greenberg pointed out that an availability crisis where a business literally cannot buy insurance at any price, forcing them to shut down or operate illegally, is exponentially worse for an economy than an affordability crisis, where the insurance is simply expensive.
It was a stark reality check delivered directly to the regulatory ecosystem.
Okay, we have covered an immense amount of ground here. We've dissected the nearly $3 billion in operating income, the 80.4% current accident year combined ratio, the massive leverage of their float, the catastrophe paradox, the twin growth engines in U.S. agriculture and digital partnerships like Nubank, their ambitious AI efficiency targets, the softening E&S property market, and the very real market dynamics of social inflation.
That's a lot of data.
It is. It is time to synthesize this data. It is time for the bottom line.
Based on a comprehensive analysis of the mechanical strength revealed in this earnings call, our definitive stance on Chubb right now is highly bullish.
Highly bullish. And the why behind that stance anchors on one specific ultimate wealth creation metric for an insurance stock.
A metric that transcends quarterly earnings noise.
Right. It is tangible book value per share.
If you are a true value investor looking at the financial sector, this is the metric you obsess over. Let's define it clearly.
Please do.
Tangible book value takes the total assets of the company, subtracts all the liabilities, meaning the massive reserves they hold to pay future claims, and then strips out all the intangible assets, like goodwill or brand value.
Okay.
It leaves you with the hard, liquid, undeniable net worth of the company. You divide that by the number of outstanding shares, and you have tangible book value per share.
It is essentially the liquidation value. If Chubb decided to stop writing new policies tomorrow, pay off every single pending claim over the next 20 years, and close up shop, this is the hard cash value that would remain for the shareholders.
Precisely. It is the purest measure of how much actual wealth the company's operating engine has accumulated. And for Chubb, in the year 2025, that metric grew by an astonishing 25.7%.
To grow the fundamental hard net worth of a global financial institution by over a quarter in a single year is just a monumental achievement.
It mathematically proves that their machine is compounding capital at an elite rate.
And the reason we are highly bullish is because they are generating that wealth from three distinctly diversified buckets, which insulates them from isolated market shocks.
Let's break down that three-legged stool because it highlights why the company is so resilient.
Bucket one is their core P&C underwriting. This is the pure business of collecting premiums and paying claims efficiently.
They generated $6.5 billion in income here, up 11.6%.
Bucket two is the investment income. taking the float generated by bucket one and putting it to work.
That massive fixed income and private investment portfolio generated nearly $7 billion for the year, up 9%.
And bucket three is life insurance. They operate a massive international life business, heavily concentrated in Asia, which operates on completely different macroeconomic and actuarial cycles than property insurance.
That bucket produced $1.2 billion, up over 13%.
So look at the structural stability here. If the stock market crashes or interest rates drop, suppressing bucket two, their underwriting discipline in bucket one keeps the company highly profitable.
Right. And if a massive, unprecedented string of catastrophes hits the P&C market, their geographical diversification, life insurance earnings, and investment income buffer the blow.
It is an incredibly stable architecture.
It is a defensive cornerstone asset that is currently outputting offensive, tech-like growth numbers.
So what does this mean for you, the retail investor who is either holding CB in your portfolio or contemplating initiating a position?
If you currently hold Chubb, this transcript serves as confirmation that your capital is being managed by one of the most disciplined, mathematically rigorous executive teams in the global financial sector.
You let the compounder compound.
Exactly. If you are considering initiating a position, the actionable takeaway is to monitor the commercial property pricing trend closely over the next few quarters.
Right. Keep an eye on that 13.5% drop in large account E&S property pricing.
Yes. If competitors continue to act irrationally and drive commercial property prices down at double-digit rates, overall margins across the industry will eventually compress.
However, right now, Chubb's booming international consumer business, their agricultural profit sharing, and their $750 million targeted digital expense savings are easily offsetting that specific weakness.
You are buying into a globally diversified probability machine that does not rely on any single market to generate its baseline returns.
But speaking of that global diversification, we cannot ignore the geopolitical reality of operating in 53 countries.
Which leads us to a final provocative risk factor that we want to leave you with.
It was raised briefly during the Q&A session by an analyst from Raymond James, and it is a macroeconomic force that Evan Greenberg literally cannot control.
Yes, we need to talk about foreign exchange risk, specifically the strength of the US dollar.
Because Chubb is a global behemoth, they generate a massive percentage of their premium revenue overseas in foreign currencies. They are collecting euros, Japanese yen, Mexican pesos, and Brazilian reals.
And Greenberg explicitly stated on the call that they do not hedge their revenue or their income against currency fluctuations.
To be clear, they do match their assets and liabilities in the local currency. If they owe claims in yen, they hold bonds in yen.
That is sound fundamental risk management to protect the local balance sheet from blowing up. But when the quarter ends and they have to translate all of those global profits back into US dollars to report their consolidated earnings to Wall Street, they are completely naked to the exchange rate.
They are completely exposed. So here is the macroeconomic puzzle for you to mull over as an investor. If the US dollar strengthens significantly in 2026, perhaps due to a flight to safety during geopolitical conflicts, or because the Federal Reserve holds interest rates higher than foreign central banks, that strong dollar acts as a massive financial headwind for Chubb.
It is basic currency translation. If the dollar is exceptionally strong, every euro or real they earn overseas translates into fewer US dollars on their final income statement.
Could a soaring US dollar index simply erase the massive 25% growth gains they are making in their Asian and Latin American consumer markets?
It's a real possibility. On paper, the actual business might be thriving, acquiring millions of new customers through Nubank. But the reported US dollar profits could theoretically stall out simply because of the exchange rate.
It is a fascinating, undeniable risk. Greenberg admitted during the call that if the dollar strengthens, we pay that price.
It is too expensive to constantly hedge global revenue streams, so they simply accept the translation volatility.
The intrinsic underwriting engine of the business is nearly flawless, but the reported financial results are permanently tethered to the chaotic reality of global currency markets.
And that is the ultimate paradox of achieving true global scale. You successfully diversify away the risk of a single geography. A hurricane in Florida doesn't break you.
But by doing so, you inherit the macro risk of the global currency regime. It is a geopolitical dynamic you absolutely must monitor if you are allocating capital to this stock.
The underlying machine is humming perfectly, but the atmospheric conditions it operates in are always shifting.
Well, we certainly went incredibly deep into the mechanics on this one.
Yeah.
But when a company releases data this dense, this paradoxical, and this consequential to the broader economy, you have to do the hard yards to unpack exactly how the machine works.
Yeah, really do.
Thank you for joining us on this exhaustive, data-driven exploration of Chubb's operating architecture. Remember, the house always wins. But if you do your homework, understand the math, and monitor the macro environment, sometimes you can invest in the house. Stay informed, stay critical, and stay profitable.